Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY, the Qs, and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 6 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick off today's S&P analysis with the SPY daily time frame chart, and then we'll jump on over to the sectors after that. The main focus on the daily time frame should still be this balance area right here. On Monday's session, we did break underneath the bottom of balance and we closed underneath. Although it was not a very impressive close, it would have been much better for the bears to close on the lows of that daily bar. However, we follow that up with Tuesday's action where we test back above 360.75, get no price acceptance from the buyers, and then we get that fairly weak close and put in a new lower low from the daily chart perspective as well. Tuesday is really the nail in the coffin that says, yes, bears are in control from a structural and location perspective. Today's session, Wednesday, we get pure price acceptance underneath 360.75, the bottom of the daily balance, confirming that, yes, indeed, bears are in control. However, this may seem fine and dandy. It may seem like, okay, we're just looking for trend continuation to the downside. But what do we know is coming out tomorrow at 8:30? It's that dreaded CPI number, Consumer Price Index. This is a huge measure of inflation. The Fed pays very close attention to it. Whether or not they admit that is a different story. And we know that today's session was the release of the smaller, less important number, the PPI read, which is Producer Price Index, and that missed the expectation by almost twice the amount. So is that going to forecast that CPI will be a terrible read? I'm not going to make any bets based on that, but I want you to know that CPI and tomorrow's read should cause some significant market volatility, and it may catch everybody off guard. So here are some scenarios to pay attention to. We will, of course, be covering CPI live tomorrow, starting at 8:15. The number comes out at 8:30, so join us here on the channel. But here are some scenarios to watch out for. Scenario number 1 is opening inside of this range right here, basically inside today's range, or a very, very small gap up that is not above 360.75, or a very, very small gap down that is not beneath 355.25. If we open in between those two levels, then fine, you're looking for either a short up against 360.75 if we start to show signs of weakness there, just reaffirming that the bottom of balance is acting as resistance, right? And then you can look for some more downside. If we open above that 360.75 level, so we open up here, I think that makes lots and lots and lots of sellers nervous who are short late to the party in the hole, so to speak, underneath the bottom of the balance area for these 2 days. And they say, oh goodness, I don't know if I can continue to hold this into the end of the week. So sure, we might get a little bit of a move to the downside early on in the day's session to correct some of the inventory. But if we rally and hold 360.75 tomorrow morning after a gap over the level, that would strike me as very bullish. And who knows, maybe we head up towards this gap overhead based on the amount of shorts that possibly get squeezed out of their positions. Okay, so keep a very open mind tomorrow and continue to use 360.75 as a pivot point. Now, what about the downside? If we produce a nasty gap down tomorrow and we open underneath 355.25, I would watch for a rally first to correct some of the inventory, because we're basically making a move straight to the downside, right? So a rally first that takes out some of the inventory, look for a gap fill rejection either at 355.25 on the back test or today's low. Today's low, just to give you the exact number, is 356.30. So those are 3 different scenarios that you could watch out for on tomorrow's session. Just to recap them, it's actually 4. Opening inside, watch for a short up against here and a rollover. If we open inside and break above, fine, be patient, wait for a higher low, something that confirms 360.75 as support. You don't want to buy that initial breakout. That's very, very risky. Wait for the higher low. And then the other one, of course, would just be here. Breakdown of this level. I wouldn't really look to buy 355.25 as an area of support tomorrow if we open inside of the range. I would not really be looking for this scenario here. If it happens, then hey, you can say gotcha in the comments section, but that's not something that I would read into as a scenario. And then of course the 2 gap scenarios, opening above, look for a gap fill, reversal that catches all of these shorts off guard. We get a squeeze, possibly head up towards the top of the daily range and the bottom of the gap at 369.32, gapping underneath, watch for the rally first and reject rejections to come into play at 355.25 to preserve the daily bearish trend that we just walked through from a price action structure location perspective, okay? So be open to all possibilities. Tomorrow is CPI. Just to reiterate here, CPI 8:30. We will be covering it live on the channel starting at 8:15. So that's what I've got for you from the SPY daily time frame perspective. Let's take a look at some sectors now and see what's going on from that perspective. So who was leading, who was losing, and where was the weight today? The energy sector led the pack up 1.47%, and the XLU for utilities was at the bottom of the barrel, although yes, I know it's not at the bottom of the list. It was clocking in at negative 3.18% on the day's session. Very nasty move inside of utilities. As we know, energy sector is a lightweight sector. We do not want that leading the charge on any given day where the market's trying to make a rally. That's that upper wick here, right? So that does strike me as concerning. Energy is D for defensive. It's a lightweight sector. It should never be towards the top of the list. But given that we had a red day, fine. It's not like we're seeing a major divergence just yet. Utilities being at the bottom of the barrel, not a huge concern. It is also D for defensive and a fairly lightweight sector. So instead, where were the heavier weighted sectors? Certainly, the XLK, the tech sector, the heaviest weighted component of them all, was down 0.38%. The XLF, second in our lineup in terms of weighting, was down 0.26%. And then the XLV for the healthcare sector, second by market cap, third in our lineup, was down, I don't know what happened to the drawings, apologies for that, but it was down 0.81% on today's session. So a pretty bearish day across the board in the heavyweight sectors where it really matters. Let's check in on the structure and see how these charts are continuing to unfold. And just remember that CPI and being open to all possibilities does hold true for everything that we look at on today's session. So in the energy sector, barring CPI, right, we're only going to talk about structure and trend here. We'll talk about where it's bearish, where it's bullish. This chart does strike me as bullish. We've got a massive rally, a reasonable pullback that is retesting and confirming this as support at 78.50, which is also the neckline of the prior double top. So we're back above that structure. It's holding here. This chart does strike me as bullish. If we continue higher, the target should be the equal high around 82.86 and then watching for follow through to the upside after that. If this chart is going to be bearish, it's really got to get price acceptance underneath 76, to be quite frank with you. 78.50 is great, but we can still produce a higher low above that 76. If we fall underneath 76, that's where we clearly have all of this thin structure, and we probably make the rotation closer to 72, which would feel more comfortable for the bears, right? So that's the energy sector in a nutshell. Really important to pay attention to this one as it's been leading the charge to the upside. So you want to see it cool off if the market's going to try to find a bottom here. Next up, XLY. Consumer discretionary, certainly a heavier weight sector. This one's looking fairly bearish. The reason I'm leaving it zoomed out just for a little while here is to point out that the relative strength is wearing off. We're right back down towards the June lows, whereas this one was holding up initially quite well. So that is not the case anymore. On today's session, we did get more bearish price acceptance underneath the breakdown level from here. Let's go front and center with this price action so it's not too hard to see. So 2 days of price acceptance underneath the breakdown point. Again, this does strike me as more bearish than bullish. I would favor a breakdown, but with CPI and being open to all possibilities. If we move higher, I would probably look for the rejection off of 145. That's your next bear trade if the rally comes first. And the only time to flip bullish is on a move that produces a higher low above and gets price acceptance back within this range above 145. So that's the critical component of flipping bullish in the XLY. It's a heavier weight sector, which is why we spent some time on it. Let's speed up through the utility sector, falling off of a cliff that goes without saying. This is not something that you should chase to the downside, and it's also not something you should try to catch the falling knife in. I would say stay away from utilities, but overall it's slight downward pressure for the S&P 500, remembering that it's still a fairly lightweight sector. The same thing is going to hold true in energy. Let's not spend too much time, real estate, not energy. Real estate here, same thing as utilities in terms of sector weighting, not a very impressive weight. It's also falling off of a cliff. It's not something you should chase to the downside, and it's also not an obvious long to me. So I would just stay away from real estate, but it does strike me as very slight bearish pressure for the S&P 500. XLV is where we've got some weight. This is the second heaviest weight by market cap, so let's spend some time on it. Remember what we discussed in the weekly watch list video from Sunday. All price acceptance that remains underneath 124 does strike us as bearish, even if the market's just going sideways here in the healthcare sector. And that's what we've gotten throughout the entirety of the week. So it doesn't seem, out of the ordinary to me that the SPY has seen a little bit of breakdown when the XLV can't even get out of its own way. The reason that this is so bearish is because we know 125 is the bottom end of the monthly balance, and 124 was the neckline of this double bottom from right here. So all price acceptance underneath both of those levels, of course, falls into the bearish category. So going forward, now that we've got more balance taking place underneath, we've got the lower highs in place, we've now got the equal lows. Knowing that we're in a downtrend, it would be reasonable, would it not, to be looking for the next lower low, which would entail a breakdown of 120.65. So the XLV does strike me as bearish pressure for the S&P 500, but again, be open to all possibilities. If the market sees a rally based on CPI, the only time to solidly flip bullish here in the XLV would clearly be a higher low confirming back above 125. And with only 2 trading days left in the week, I'm not sure that that will be the case, at least up until Friday. Let's continue along and take a look at the XLB for materials. What do we see over here? This one was looking like it wanted to produce a higher low off of the top of balance, but today we did close underneath. Unfortunately, again, this is such a lightweight component of the S&P. It's only 2.5%, so it's not really going to move the needle, but it does strike me as slightly more bearish than bullish, failing to hold up at the top of the balance with that close underneath. So watch for slight downward pressure. If it rallies, again, it's not going to save the day. The same thing's going to hold true here inside of industrials. The chart looks almost identical, a little bit heavier weight here. This is 7% of the S&P 500, but it is failing back down into this box after a 4-day consolidation period. The more price acceptance we get under 85 is the nail in the coffin for the rotation here. Again, think about what we discussed in the XLV. In a downtrend, you've got all of these lower highs, right? The next logical thing after making an equal low would be the lower low for the gap close at 81.65. So bearish pressure here in the XLI. To get bullish, it would have to be a higher low above 88.20. Next up, we've got the XLP for consumer staples. What's going on over here? This one's actually a little bit more impressive with a move higher throughout the entire course of the week, but the structure is not really, it doesn't make me feel warm and fuzzy on the inside. And also, remember that the XLP is still D for defensive, right? Consumer staples are a defensive sector. What I would look at instead is kind of this trend line and this trajectory, and the fact that we could be putting in a lower high here with the inverted hammer that printed on today's session. So going forward into the remainder of the week, I would watch 67.28 like a hawk. Breaking that, look for your equal low, and that of course is bearish pressure for the S&P 500. If we just go sideways, fine. I would give this one the benefit of the doubt and say that it is just neutral if we hold up above 67.28. Next up, the tech sector, the heaviest weighted component of them all. Let's spend some time here. Obviously underneath the June lows, that goes without saying. Zooming in, let's make this one pretty so it's not too hard on the eyes. There we go. Here's your balance area, right? We're firmly underneath that. We're firmly underneath the local lows, so more bearish than the S&P 500 on a relative basis. We've made the new lower low, so this can actually rally and afford a lower high. Ideally, that gets put in somewhere underneath 119.75 for then the rollover to come back for the gap fill underneath. That would be a bearish setup that I would want to participate in. I'm not sure that I'm too interested in shorting this on the new lower low after we've already moved from the top all the way down to the bottom without any sort of pullback. So anything that rallies first and rejects off of 119.75, possible short entries with a stop just overhead in the XLK there, and that of course would be bearish pressure for your S&P 500. The only time to flip bullish in the XLK, let's say that the CPI number does produce a massive rally, would be to do something like this, above 122.20, confirming with some sort of higher low well above 119.75. So it can happen kind of anywhere in this zone, but it wants to be above 119.75 for the higher low, and that would have me feeling slightly more bullish than bearish, just based on the fact that we could start to build out some sort of inverted head and shoulders, right, over the course of time for a trend reversal. Those are the scenarios in the XLK. I would not be too aggressive with new money shorts down on the lows. Next up, XLF. What's going on in financials? We'll zoom in on this one as well. Second heaviest weighted component in our particular lineup. Let's zoom in on it. Good. We're looking great. This one is much more like the XLV, right? Obviously, we've got our lower highs in place. That should go without saying. We are coming in for the equal low. So if we do see a breakdown, it would be logical to expect the next lower low in an overall downtrend being produced. We already got the lower low in the XLK. Let's see if the XLF wants to do it as well. Do remember that earnings season is around the corner in financials, and on Friday before the bell, we will be getting some pretty heavy hitters. Wells Fargo, JP Morgan, Morgan Stanley, all those guys are reporting then. If earnings season is a flop, that would be a great catalyst to send this lower and make that new lower low. Keep in mind that there's quite a distance to travel in the XLF to the downside. Next support is at 29. So knowing that this distance is so large here, to me, that does seem like a bearish indication for the S&P 500, because if we fall apart, there's some serious range to travel in the downward direction. If we do rally, the only time to get bullish in your XLF is with a confirmed higher low above 31. By confirm, I mean we have to take out the high of whatever it was prior before that pullback. So really, the only time to get bullish is on that interaction right here as we breach up and over the prior high after a higher low, right? So just thinking about trend counts, that's what I would want to see to get bullish in the XLF. Guilty until proven innocent here, I suppose, on the bear side is what I would say about the XLF. And what else? From a weekly perspective, sorry for the little mind glitch there. What I want to get at from the weekly perspective, right, is that if you're going to flip bullish on the weekly perspective, it's got to be over 32.50 for the double bottom neckline to be panning out. So again, a lot of work to be put in if it's going to flip bullish, but those are the scenarios really favoring a new lower low, given that we're in a downtrend and we just made the new equal low, okay? Next up, XLC, last but certainly not least from a sector perspective. Zoom in right in on this thing. It's ugly, it's hideous. We know it's been that way for a while. Relative weakness in the XLC. It gave us the new lower low. We've got a little indecisive doji that backtested the bottom end of the range from in here and failed. So I would carry this forward as a bearish data point. But again, is it wise to be shorting new money shorts here, looking for massive rollover? Not really. I would watch for a lower high or more of a bear flag to build out. Then your next target underneath is going to be 46.40. To get bullish here, it's got to be the higher low scenario here, like we just talked about in the XLF, with some kind of break and confirmation of the higher high to reverse the trend. Maybe it builds out some kind of double bottom, who knows, but not, stretch of the imagination, at least into Friday. I would carry this forward as a bearish data point. All right, that has been a sector rundown. Let's take a look at the ratio grid now. If you don't know what this is, top right-hand corner shows you how to set it up, and we'll do an interpretation right now. The top four sectors are the risk-on sectors, the heaviest weighted sectors. Notice that your XLK, the heaviest weighted component of them all, continues to look absolutely horrific from a relative perspective. This is not a great sign. It will never be risk-on unless this is trending in the upward direction, or at least neutral around the 50 SMA, being supported by really aggressive looks in the other three here. So this is not helping the case whatsoever. This would, at least to me, be a bearish data point. XLV, although the ratio here is pointing and screaming to the upside, we know that the structure really isn't that bullish. So I'm not impressed with the ratio here. We know that a breakdown of the lows obviously opens up the door for trend continuation. XLY, a little bit more neutral, fine. I'll give this one the benefit of the doubt, but certainly one of the big four is not enough to turn risk on, especially with this look here in the XLK and even the XLF with earnings season around the corner. I would really chalk this up to more neutral. And if earnings season really kicks it off to the upside, fine. We'll read into it as a slightly more bullish data point. But as of right now, it's not quite going on from a risk-on perspective. Risk off, the bottom four sectors down here, the lightweight sectors, really what we don't want to see leading the market. Notice that the XLP is perking back up. Sure, it's a little bit more neutral in this overall range, but it's certainly towards the upper portion as opposed to the lower portion. You can't really argue with me on that one. XLE ripping to the upside. That is a big indication of risk off being on, if that makes any sense. So it's just saying, hey, market's not quite ready yet, right? So energy sector is a thorn in the side. XLK is a thorn in the side. Utilities falling off of a cliff. We talked about that chart, and real estate as well. Lighter weight sector, so not overly concerned with either of those. It's really energy that's screaming to the upside. That's like, hey, risk off, right? So that is the ratio grid. Let's take a look at the TNX now. And on the TNX, we are looking at the 10-year interest rates. And what I would point out in this particular chart is that, yes, we got the bull flag breakout that we were discussing in last week's episode here, or the Sunday video. I'm not sure which one it was, but regardless, we are moving higher. We're coming into that 4.0. And with CPI tomorrow, all it takes is a hot inflation read, and you better bet that rates will continue to rise here. One thing that I do want to point out is that if we go on over to the countdown tool, remember that the jobs number from last Friday, we talked about this on Sunday, right? The jobs number from last Friday pretty much guaranteed the 75 basis point rate hike for November. But going forward here into December, I would point out that this, as we checked in on Sunday, was sitting about 10% lower, closer to 18% or so. And already, based on the PPI number being pretty bad this morning, the miss from the expectation, this has jumped up 10%. So if we get a hot CPI read on tomorrow's session at 8:30, I would would say that this starts to pile in over here, and we might be in store for more of a 75 basis point rate hike in December, which of course the market, I would imagine, does not like very much. So that's the general relationship that we're continuing to track. And again, we will be covering this live tomorrow at 8:30 when the number comes out. Back on over to the platform, that was the TNX. Let's take a look at some volatility instruments here. So the VIX is up first. What's going on here? Still showing plenty of volatility in this marketplace. There is the box. We're sitting right at the top. One thing that I will say is that it's not often that the VIX just kind of hangs out and goes sideways here for a long period of time. Notice that when you make these spikes, they're relatively short-lived, and the market does tend to come lower after that. It doesn't guarantee that we head lower here, but it does guarantee, or maybe I shouldn't say guarantee, but the odds would favor either a continuation spike up towards the 40 handle, which would be a big red flag for the market, or, hey, we settle down a little bit, and maybe the market gets a little bit of reprieve from the selling that we've been experiencing over the past couple of weeks, really. So the VIX still indicating that, hey, we should be getting a pretty volatile reaction. Whether or not volatility increases or comes in a little bit is a different story, but volatility is certainly in the marketplace, and it hasn't gone anywhere, even as we've gone very slightly lower throughout the entire course of the week, right? So next up is the VVIX. This is the volatility of the volatility index, indicating that, yes, people are starting to hedge properly for CPI. We're above that 103 read, which is a good look. It's going to reduce the amount of flood effect that we get where everybody rushes in to buy SPY puts, buy VIX calls. It reduces the chance that we get some sort of gamma squeeze that spirals out of control. So I like what I'm seeing here, but it would also be an indication, right? These things go hand in hand, that hedge funds, market makers, large institutions, they are seeing the risk on the horizon, which what does that tell us, right? If they're preparing, then who knows what could possibly happen. Again, this is not a directional call. It's just a call about volatility, and the market is still in quite the precarious spot. Next up, we'll take a look at the /VX, which are the VIX futures. Oof, that's a tongue twister. Too many V's. But scrolling down, what I want to point out here is that we are still in backwardation, right? So there is 32.13 and there is 31.82. Call it inversion, call it backwardation, whatever you want to call it. There is still more risk in the present day right here, right now, than there is in next month's trading session, 35 days out on the time horizon. So again, just an indication that yes, volatility is still high. That's all we've got there. Let's get back on over to the S&P 500, and we'll look at the market internals. Here we go. If you don't know what this screen is, top right-hand corner's got you covered on a tutorial of how to set it up, and also what it all means, how you can read this data for yourself on an intraday basis. So zooming in on this week's action here, what I would point out is that it definitely seems as though the market's waiting in limbo for the CPI read. Look at the volume flows on both Tuesday and today, Wednesday. Very, very sideways and neutral. It's not like anybody is making any big bets ahead of this CPI number. So that supports the idea that the market is waiting with bated breath, and we should see a sizable reaction once that number is public and everybody kind of knows the deal. And hey, this is what the Fed is going to do, right? In terms of that 75 basis point rate hike. In terms of the advanced decliner, I really like what I'm seeing over in this quadrant here. Main reason is that, remember, we had discussed that the market will not see a trend if we're getting massive degrees of overcorrelation on either side of the advanced decliner. So to see this going sideways does strike me as a positive indication. So if the CPI number isn't too bad, but it's kind of bad, and we start to see a rotation to the downside, I would say that the advanced decline line is positioned well enough to start to see some serious market rotation, aka trend develop, and hopefully we can get something tradable out of it. The tick is also just indicating that yes, market participants are waiting with bated breath. I would not read into that too much, especially as we got an inside bar on today's session. Last but certainly not least for our S&P analysis is the market profile. Nothing to read into, again, from this perspective, overly aggressively at least. If we zoom in on this, you will note that we've got a poor high, and we've also got, it's not a poor low. I would say it just lacks meaningful excess, material excess as it's called. You know, when we're trading in a range that's, you know, over 100 points or 50 points, whatever you want to call it, it's a very sizable range. To only see one tick or a couple of ticks of excess at the lows doesn't really strike me as like the proper end to the auction. Now, there was a good volume taper down towards the low, but again, I'm just not sold on the idea that this is the end, and it makes sense as well because we know this is completely contained within the prior day's value area. So here is Tuesday's value area high. There is Tuesday's value area low. today's entire range was contained within. So seeing a move above and seeing a move below should produce some type of reaction. And again, with CPI around the corner, be open to all possibilities. Nothing else to really read into from that perspective. A very balanced day, very normal looking bell curve here in the market profile. It's not giving us a whole ton of information. So with that being said, let's dive on over to the QQQ and start talking about the remainder of the broad market. Then we'll get into some trade ideas in the core list as well as the additional scans. So in the QQQ, just like the XLK, you'll notice that we've got relative weakness. We're underneath the balance range. We're underneath the low from here as well. I would say the bears do appear to be in control, but again, be open to all possibilities with the CPI. The numbers you're going to want to focus on are 367.50. Notice that that's the high and rejection point of Tuesday. If we open in between, possibly looking for rejections off of it, that keeps the chart bearish. If we open in between and rally above for something that does this, you need the higher low confirmation above 267.50. Gapping over the level, I would start to focus on the bottom of the daily balance at 272.65. There is a possible short entry there, looking for rollover to produce a lower high on the daily time frame chart. Opening underneath, of course, is bearish, but you're pushing your luck, shorting into the hole. I would not be looking for new aggressive shorts down towards the lows on a gap down. It would have to be an intraday scalp only after a rally to close the gap. Maybe there's something to do up against that 261.25. And what was the other scenario? Gapping up above, right? A pullback to hold 267.50. That would also strike me as interesting for a long setup, noting that these shorts will likely get squeezed if the CPI number is good, okay? So some scenarios and numbers to be thinking about in the QQQ. Next up, let's go ahead and take a look at the IWM. What's going on in the IWM? This chart is surprisingly bullish, and hopefully you can see why, right? We do have technically a look above and fail. We never made it to the bottom of balance. We're still in the balance on a relative basis. We never took out the June lows. This is holding up quite well, and we did produce a hammer candle on today's session. We even closed back within the Monday session, right? So think about this. We break down underneath the top of the balance, 169.20. We explore underneath that candle's low on the Tuesday session. Where do we close? Back inside of the Monday session range. What happens on today's session? We open here, we explore lower once again, but where do we close? Back inside of that Monday range session. So it does seem to me that the sellers are running out of bullets here in the IWM, and I would be probably looking for the possible long signal from the IWM if this can just get up and over 169.20. Remember that this for us is much more of a market indicator as opposed to something that we trade. If you're looking for the bullish outcome on a higher time frame, we of course know it's the neckline of this double bottom way overhead at 177. So for higher time frame traders, swing traders, not quite out of the woods yet, but I do like what I'm seeing from a relative perspective and the strength here based on the psychology of these candles. Again, be open to anything. CPI could easily come in here and wipe all of that away. We could gap down underneath the bottom of the balance here, and it could completely fall apart. It can go in either direction, but purely based on price action and structure, that's what I would say about the IWM. The bottom of your balance here, just to give you the number in case you can't see it, is 163.75, and that opens up bearish possibilities. Let's get into our core list of companies. We'll try to keep it brief here. I don't know how long the video is today, but if you've enjoyed it so far, feel free to drop it a thumbs up. Always goes a long way in terms of showing support for the channel. Here we go on Apple. This chart is supremely bearish. I really wish CPI was not tomorrow because this is just a beautiful descending triangle. Lower highs, equal lows. We've got the equal low to here as well. A breakdown after a lower high from here, right? So this is your lower high. Equal lows. I mean, it's just a beautiful chart setup to move to the downside, but with that CPI sort of question mark, if you will, pretty tough to get overly convicted here. I'd love if Apple could open inside and then break down tomorrow underneath 138.25. Here it is on the hourly time frame chart. Might become even more clear, right? So there is your trend line, or excuse me, wrong tool. There's your trend line. There's your breakdown point. I love the pattern. It's just like it literally belongs in a textbook, right? So under 138.25 does open the door for breakdowns. If CPI launches us up into the oblivion, I would possibly entertain the idea for shorts off of the gap close, up around 145.15, noting that yes, we would still be in a downtrend with lower highs in place if we reject off of the gap close there. 145.15 is your number. Anything that just chops around in here, I would not be overly aggressive with directional trades. Next up, we've got Netflix. This one is breaking down and not holding up as well as it used to. With the retest of 221.50 today, I would say that this would be normally primed for a short setup tomorrow morning, looking for the downside after the sort of dead cat bounce, if you will. But again, CPI, be open to anything. 221.50 is the number to watch ultimately. Breakdowns of 214 do open the door for sellers. I wouldn't really be overly aggressive on the long side above 221.50. Instead, maybe looking for the rejection off of 234 if we do see a rally first. So that is Netflix in a nutshell. Again, for many of these stocks, I just want to give you some levels and scenarios to possibly be thinking about, just because, again, I don't know what's going to happen with CPI. If I did, number one, I wouldn't be telling you, and number two, I would be a very, very rich man. Anyways, Tesla. What's going on here? Finally, a green candle after falling off of the cliff, if you will. So this one actually gets interesting up and over 219. I would be looking for bullish outcomes over that candle high. That would seem to me like you could catch the dead cat bounce. Again, CPI, be open to possibilities. If you're not in love with the long setup, you probably want to watch for a short off of 230.225. If it just continues to consolidate down here, a breakdown of 209.50 can get you closer to 194.50, but I would not advocate for new money shorts unless we put in some sort of meaningful bear flag consolidation first and then break down. And with earnings around the corner, I don't know how aggressive I would be with new money shorts here in Tesla. Google up next. I know I said I would speed it up through these companies, but I don't think I'm doing that. So I'll try to do that. I'll try to be more mindful of that as I'm zooming in here on Google. This chart, extremely choppy. Nothing to do in Google, honestly, until we can get out of this box that I've just drawn. Until we can firmly accept underneath 96.25, until we can firmly accept over $100.50, there's not going to be a whole lot of trending activity. Now, I would say that the chart does look more bearish than bullish with these two inverted hammers, rejecting the top of this balance from in here, the bottom of this balance from in here. So the sellers do have the upper hand, but please, let's get some price acceptance underneath 96.25 before we get overly aggressive. This one would seem to me like a reasonable candidate for breakdown, considering that it's consolidated for quite some time now. I would not feel chasey going after Google downside. Next up, we've got Meta. What's going on in the metaverse? If I could get a zoom here inside of Thinkorswim, thank you for cooperating. This is another one of those stocks, kind of more like Tesla, where I would not advocate for new money shorts. We've already got a breakdown and a doubling of the range in play. We hit the target. We are good to go from that perspective. Next trade wants to either produce some balance and then break down again after a lower high or something, or a retest here possibly gets interesting for the break, retest, and then go, right? So 134 is a short setup. I would not advocate for shorts if we just hang out down here. Continuing lower, I would watch for the snapback rallies off of 123.85, and if we do get a nasty breakdown, if there is some nasty continuation, 119.50 is your next downside level. Next up is NVIDIA. What's going on in NVIDIA? And these charts are loading horrifically with a ton of empty space off to the right. We'll have to fix that after the show today. But regardless, thank you for bearing with me. In NVIDIA, almost a double inside bar, not quite, but inside bar today, but Tuesday was not inside Monday, so that's a tongue twister. Anyways, if we take out the high here, 117.25, look for the retest of 122.50. If we take out the lows, again, I would not advocate for new money shorts here. I suppose maybe a scalp on the intraday, but not a big swing trade short down here on the lows, given that we've already made this rotation and we're so far underneath the balance area. That level is going to be 114.20. If we can crack that with some conviction, 109.85 and 106.25 come after that. Next up, Microsoft. What's going on in Softy? Zooming in on this, these charts are just so ugly as they're moving towards the lower right-hand corner. Anyways, there's your balance area, just like Microsoft, or excuse me, just like Meta rather. I would not advocate for a new money long down here, and instead, or maybe it was NVIDIA, I'm all over the place tonight, so drop a comment if you appreciate the stream. The brain's getting a little bit all over the place here. Anyways, inside bar. Just like what we talked about in NVIDIA or Meta, I don't remember which one it was, although it was just a couple of seconds ago, 235.10. A retest of this looks like a short entry for a rollover, producing a lower high on the daily time frame chart, taking out the two equal lows. The chart can move lower. There is a sizable range underneath us, so maybe if you're looking for a short, this is the candidate, given that the range underneath us is so large, under 225.75 to 216.50. Next, last but certainly not least, we've got Amazon, the mini beast. Last but not least, the mini beast, as we typically say. This is also a candidate on short watch, given that we have the balance area still intact, failure to really accept prices above on that rally from Tuesday, just hanging out with an inside bar on today's session, cracking the lows here, price acceptance under 112.50 opens the door to get us closer to 108 even, and that is a reasonable candidate for some downside, given that we're not extended and we're still playing around in this choppy balance range. Remember that for everything, be open to all possibilities because of CPI. I've got 6 trade ideas to blast at you, and then we're going to head out of here for the night. So AMD is up first. Can you believe it? We're revisiting AMD, and I've got to fix this. It's just unbearable to keep looking at these charts like this. So here we go. That is better. Zooming in on AMD, bear flag quite simply, 3-day balance range, again, open to either way, depending on what CPI wants to do. So it's either going to be over 58.62 or under 56.50. Your target on upside is a retest of 63.09. So let's just draw this in. Boom, there you go. A break here gets you there, and a break down. I probably just wouldn't chase it to the downside, to be quite frank with you. As you guys can probably tell from the channel, I'm much more of a long-sided trader than a short-sided trader. Next up is PYPL. What's going on in PayPal? Here we've got a hammer candle. If we can take out those highs, notice that we get a little resting bar in here. If we can take out these highs, if we can recapture this kind of area here at 84.85, look at the thin structure from the breakdown. Here's the hourly chart. Probably makes it a little bit easier to see, right? Obviously taking out this resistance zone, not a whole lot of structure until we close the gap all the way up there at 89.79. So watching for intraday bullish setups, boom, there's your trade. Looking for some upside in PayPal if CPI resolves to the upside. KO for Coca-Cola is up next. This is a short trade, and hopefully you can see why. We've got a breakdown level here, a beautiful, nearly perfect retest with an inverted hammer cracking the low of that bar. Look for the equal low here. So on an intraday setup, that would look something like this. A breakdown of this support roughly around 55.12 opens the door for a rotation here. Hopefully an intraday setup gives us tighter risk reward with a stop that can go somewhere around this rough area 55.50. That is KO on your downside. Next up is DOCU. DOCU is the ticker there, DocuSign. This is the hourly chart. We want the daily to talk about the idea. This is a bullish setup, right? So we've made the new lower low. We produced a hammer candle down here at the lows. If we can take out the top, it is game on through the thin structure for your next lower high. Basically looking to play that little uptrend, the snapback rally up towards 50, over 46 roughly. Here is the hourly time frame chart to illustrate that idea. Very similar to what we discussed in PayPal. There's your resistance point, very thin structure on the way higher until we start to get to the bottom of the gap at 50.23. That is DocuSign. Next up is McDonald's. MCD is your ticker there. This is the hourly chart, back to the daily. And this is also a short setup, right? So you can see we're rejecting perfectly off of this resistance point here. We're building out like a weekly bear flag, right? If we roll over underneath 236.50, look for the equal low here. Now, it's much more, you could play it as a balance range and you could say, okay, breakout of 240 gets interesting as well. But look at the hourly chart and look at how harsh this rejection was right off of the level from in here. So 239.89, as long as we're underneath that, I would watch the bearish outcome underneath 236.50 to rotate to 232.50 on your downside. That's McDonald's. Last but certainly not least, we've got PENN for Penn International Gaming. Davey Day Trader, where are you? Hopefully your account's still intact. Wink, wink, if anyone's seen that tweet. But regardless, here's a double inside bar hammer setup, right? So boom, take out the highs, rotate up towards the highs in there, and this would also be confirming a higher low, right? From here to here, that is a higher low on the daily time frame. It's also supporting right off of the gap close and top of the prior balance, which is why I like this setup. Not only is it the hammers, but it's right at critical structure. Taking out the highs gets interesting for the rotation here. Equal high, can we form a new daily uptrend? We will see. That's all I've got for you on today's video. If you enjoyed the episode tonight, drop me a thumbs up or give a comment down below. I appreciate both of those things. And with that being said, I wish you all a green trading week.